Daily Fiscal Pulse for the 25th of March, 2026. This covers Wednesday's session. The numbers are settled, not live, so keep that in mind as we walk through them. Quickly, before we get into the fiscal side, here's what the market is focused on. The dominant theme is Iran-Middle East conflict. Headlines around Trump extends pause on attacking Iran energy facilities to the 6th of April are setting the tone, and that's clearly feeding into price action. Narratives shift fast though. The flows tend to be more honest. A notable spending day. On the fiscal side, the net transfer printed $39.2 billion, with household transfers carrying most of the weight at $32.1 billion. That's meaningful liquidity being pushed into the system. And prices confirming that picture. ES futures closed at 6,642, still well below the 20-day moving average at 6,758. The broader 20-day range sits in a 404-point range and is trending lower. So both flows and price are broadly telling the same story. The day-to-day is one thing, but the trend is what matters here. The 5-day average for government spending is now running at about $5.8 billion per day. Compare that to the 20-day average, which is closer to $10.2 billion. That's a noticeable slowdown. In simple terms, there's less liquidity being pushed into the system, less cash making its way through households and ultimately into the markets. Financial conditions are tightening as a result, and the annual numbers back that up. Fiscal year-to-date spending is sitting at $971.1 billion, which is roughly 15% lower than the same period last year. That's a meaningful reduction in fiscal support, and it does matter for overall liquidity. Anyone looking to add risk here should factor in the fiscal headwind. The fiscal environment here isn't exactly providing a tailwind. Our conditions gauge is currently at -55, but let's be fair about what history shows. We've seen this type of setup many times before, and despite softer liquidity, the S&P has still averaged around plus 1.0% over the following month. Markets don't move in a straight line with liquidity. They can, and often do, grind higher anyway. Worth noting what positioning looks like right now. Leveraged funds have continued to build long exposure while margin debt is sitting in the 96th percentile. That's elevated. Historically, levels like that tend to act more as a warning sign than a green light. So how does this play out in markets? With fiscal flows running below last year's levels, the cushion in the system just isn't as strong. When news is supportive, markets can still grind higher, but when risk events hit, like an escalation in the Iran-Middle East conflict, the downside can move faster, simply because there's less liquidity underneath to absorb it. We're also seeing 2 consecutive days of rising fiscal transfers. In our research, that type of pattern has historically preceded short-term strength in ES. It's not a guarantee, but it's a setup we track closely. Now, what's coming up that could change the picture? The 31st of March brings the month-end settlement window, which can shift short-term flows. The 15th of April individual income tax deadline is the single largest reserve drain event of the year. So yes, fiscal drag is clearly showing up in the data, but the pace of tightening may be starting to stabilize. The next move likely comes down to how these scheduled flows land, and that's the setup heading into the next session.